Hi, I'm Michael Haas with Live a Better Retirement Lifestyle, here today to talk about the 3 ways to fund a Roth IRA account. With the potential for tax-free retirement income, Roth IRAs have become a very popular investment vehicle. The 3 different ways to fund a Roth IRA account are: number 1, you can open up an account and contribute directly. Number 2, you can convert part or all of a traditional IRA. Or number 3, you can roll over or convert funds from an eligible employer retirement program. Now, if you're looking to open up an account and contribute directly, you may contribute up to $6,000 per year here in 2021 or $7,000 if you're over age 50. However, your ability to make annual contributions may be limited or even eliminated, depending upon your modified adjusted gross income. For single people, that income level is between $125,000 and $140,000. That's where your contributions reduced. And if your income is over $140,000, you cannot open up that Roth IRA. Married people, the income level is between $198,000 and $208,000. Again, that's where your contributions reduced. And if your income is over the $208,000, you cannot open up that Roth IRA. In general, your contributions cannot exceed your earned income for the year. However, there are special rules that do apply for spousal Roth IRAs. The second way, by converting traditional IRA assets, the good news is, regardless of your tax status or your income level, you can always convert a regular IRA over to a Roth IRA, with one exception. You cannot convert an inherited IRA to a Roth IRA. However, again, special rules do apply for spouse beneficiaries. And good news is, for self-employed people, both simple and SEP IRAs can also be converted to a Roth IRA. However, you'll need to participate in that simple plan for 2 years before you make the conversion, and then afterwards you're going to want to open up a new simple or SEP IRA if you plan on receiving any future contributions to either one of those plans. And if your income level is too high that allow you to make a direct contribution to a Roth, you can still potentially benefit from a Roth IRA using a conversion workaround, sometimes called a backdoor Roth IRA. And how that works is, you simply make a non-deductible contribution to a regular IRA and then simply convert that over to a Roth IRA. And there's no limits to the number of conversions that you may make. So you might ask, well, how do you convert a regular IRA over to a Roth IRA? Well, there's a few different ways about how you can do that. One way is to start by notifying your custodian who holds the IRA that you would like to convert part or all the IRA to a Roth IRA, and they'll provide you the necessary paperwork. A second way is to open up a Roth account at another financial institution, then have your current custodian transfer your regular IRA over to the Roth IRA. And of course, that new financial institution will have the paperwork to get that done. A third way is to just work with your existing custodian and have them distribute your funds from you from the IRA account. Then within 60 days of the distribution, you're going to want to roll those assets over to a Roth IRA that you had established. Regardless of what method you choose here, the income tax consequences are all the same. And of course, dealing with conversions, you are taxed as if you receive a distribution for that particular year, with one exception. The 10% early penalty does not apply even if you're under age 59 and a half. Now, if you've made only non-deductible contributions to your IRA, then only the earnings and not your contributions will be subject to tax. But if you made both deductible and non-deductible contributions, and you don't plan on converting the entire amount, things get a little complicated. Under IRS rules, the distributions are deemed to consist of a pro rata portion of the taxable and non-taxable parts of the account. So for example, let's say you've got $350,000 of taxable contributions in your account and $50,000 of non-taxable contributions, with $100,000 of taxable earnings, for a total of $500,000 in your IRA. You can't convert only the non-taxable contribution, the $50,000, and get a tax-free conversion. Instead, you'll need to prorate the taxable and non-taxable portions. So in this case, 90% of all distributions are going to be taxable, including any conversions, and the remaining 10% is going to be non-taxable. And you can't get around this by using separate IRA accounts. Under IRS rules, again, you must aggregate all of your IRA accounts, including SEPs and SIMPLES if you have any, when you calculate the income resulting from the distribution of or conversion of any of the IRA accounts. However, some experts suggest a workaround for this would be to take a total distribution from all your IRA accounts, then transfer the taxable dollars over to a 401k, assuming you have access to one and assuming they accept rollovers, and then transfer or convert the remaining dollars over to a Roth IRA. However, I would be careful. The IRS has yet to rule on this particular technique, so it'd be very wise to get advice from a tax expert before considering doing this. Third way, by rolling or converting funds from an employer plan like a 403B or a 401k. Now, you can roll funds from a Roth 401k directly to the Roth IRA, or you can convert funds from a traditional 401k to a Roth IRA. And of course, like IRA conversions, it's going to be subject to tax for that particular year, except for any after-tax contributions that you may have made. In addition to rolling or converting the Roth or non-Roth funds over, employers typically offer several distribution options. One could be leaving the savings in your former employer's plan, assuming they allow that, or two, transferring the assets to your new employer's plan, assuming they allow that, or take the distribution in cash. And of course, we know that a cash distribution results in a taxable event and may be subject to that 10% penalty if you're under 59.5. And as good as the 401k and the 403b plans are, because of the pre-tax contributions that lowers your tax each year, and for the match, for those lucky enough to get it, it's free money, crazy not to take it. As good as those plans are, I call them the cafeteria plan. And why I say that is, you may invest in the 20 or so investment options that are laid out for you with nothing else to choose from. If, however, you take advantage by rolling or converting those assets over to a Roth IRA, you now have the entire investment universe at your fingertips. The growth of that Roth is determined based on what type of investment you put inside there. That could be something as simple as cash, CDs, treasuries, just about any stock, bond, mutual fund. Some people put annuities, some people put gold. In more recent years, the very popular, very low-cost exchange-traded funds. You just got a lot of more options with a Roth. Also keep in mind that when you retire, typically after years of working and you convert that 401 or the 403b over to the Roth IRA, that account's so large that the taxable implications are so huge that you're just going to throw your arms up and say, I'm not doing it, it's too much tax. A lot of people convert over several years, maybe 5, 6, 7 years. So when you retire, you'll go ahead and roll that 403b or 401k right over to a regular traditional IRA, which of course we know is a non-taxable event. But at the same time, convert maybe 1/5, 1/6, 1/7, depending on how many years you want to stretch this out, over to the Roth IRA. So that way you can really mitigate your tax liability on any given year. Okay, and keep in mind also that assets left back in a 401k or a 403b, or even in a Roth 401k, at age 72, you'll be forced to take required minimum distributions that year and every year thereafter. If, however, you roll your assets over to a Roth IRA, there are no required minimum distributions at all while the money's growing tax-free. So there really is a lot of benefits that the Roth can offer you. So, is the Roth IRA account right for you? Well, the answer to that depends on a number of factors, and that include your current and projected future income tax rates, the amount of time you can leave the assets in the Roth IRA before you make any qualified withdrawals, your own state's tax laws, and how you pay the income taxes due at the time of the conversion. There's just really a lot of things to consider, and that's why they always say to seek professional advice. And as I always say, get that advice from somebody who's operating in a fiduciary capacity. And why I say that is, when you roll those assets from the 403b or the 401k or even an IRA over to a Roth or a regular IRA, that movement of money will generate no commissions at all. Instead, we structure the account and the relationship so that when you do better, we do better. It's a win-win for everybody involved. So if you'd like to know how a Roth IRA could benefit you during your retirement, just click on the button below labeled Let's Talk, and you can schedule a phone consultation with me or a Zoom meeting if you desire, and look forward to speaking with you.